Hello and welcome to my YouTube channel. In today's video is about mitigation. What is mitigation? The mitigation is when the price is coming back or when the price return to the order block for the big bank to break even or to close their trade that they open to manipulate the price. Okay, I don't want to confuse you. I want everything to be easier and very simple. Trading should always be simple and easy. Okay, when they're talking about the mitigation, they're talking about the move that is made by the banks to mitigate or to break even their trade or to close their trade that they open to manipulate the price. Okay, to make it really simple. Okay, after the order block has been formed, okay, look at my charts right now. After the order block has been formed, if you don't know what is an order block, maybe it's your first video on this channel, please make sure you go and watch the video about an order block, what is an order block and everything. You'll find out on that video. Okay, as the market has created an order block, remember what I said. I said the order block is when the big banks has manipulated the price in order to fool the retail traders. Okay, see what has happened here. Okay, this is a bearish order block because the last bullish candle before the down or before the impulsive move, not just a down move. Remember, put that on your mind. Not just a down move. It's not just a down move. Not seeing small candles here with bullish candles, all this mixed up candle. You can see the candles here. Only the bearish candle and a very long candle, which means it's a huge move to the downside. That's why now we have this order block and the banks have to come back and mitigate, because the banks, they don't want to take losses. They don't want to take losses. They only want to take wins only. So they have to come back and mitigate. So as they push this market, this price down, they left their trade open here, the buy trade. They left the buy trade. They left the buy trade open. So and then they push the market down. So now they have two orders open. They have the buy trade, which is a negative as they pushing the market down, and they have the sell trade or the bearish trade that they opened here, which is in a win, which is in a win because they opened the sell trade here and it's in a win. Picture as the market is here in this area. So their sell trade is in a win here, but their buy trade, which is this last candle, their buy trade that they opened here just to manipulate the price to the downside, is still on negative. So what they have to do is they have to come back, push the price up, because they can't just close this buy trade with a loss. No, they can't. They have to come back and mitigate, or they have to come and close their trade on break even or in profit. So that's why now they have to push the price back to the area. That move like this move that is going back to the order block, or this is going back to the area where they will have to close their buy trade. We call that move a mitigation. It's a mitigation. Every time the bank will mitigate their trade. They can't leave their trade, no, they can't close their trade on a loss. So what they do, they make sure they mitigate or they close their trade in profit always. That's why they used to fool the retail traders, because they know they don't take losses, they only take the winning trade. So that move, that is going back to that order that they open, in order for them to close their order that they open to manipulate the price. We call that move a mitigation. So from this area, this move to this order block, bearish order block, was the mitigation. So if we say the bank will have to mitigate, that means they have to move the price to the order block in order for them to close the buy trade that they opened here to manipulate the price. I hope you get me right. They opened the buy trade here, and then they took a sell. They left that buy trade open, running on negative $1 billion. They left it open, and then they pushed the price down. Now they have two trades. The buy trade is on negative, huge billions negative, and their sell trade, they're also on positive, or they're also on a win. It's on a winning, it's on a positive of a huge billions. So they have to look, maybe here they will close their sell trade on profit, and they will leave the buy trade. They push the price to the upside to close the buy trade on a break even or on a small portion of profit. That's what we call mitigation, when the price move back to the order block. Vice versa to the bearish order block, it's the same thing. If they push the price, as they push the price to that order block, that's what we call a mitigation. I hope you understand what is the mitigation. Thank you so much. After this video, make sure you like the video, you comment, you subscribe, so that we're gonna push this channel and help others to learn. So make sure you go to your charts and practice the mitigation. Maybe you can tell me on the comment that you found the mitigation. If you're still struggling or still have some problems on knowing or on finding, on understanding the mitigation, please let me know in the comment section. I will try and explain furthermore.